Hi there, my name is Mike Shillin, President and Lead Wealth Manager at Shillin Wealth Management. What can I say? Here we are, another crazy October in the capital markets. Just when we think we have everything figured out and the markets are on cruise control steadily heading upwards, we go through our first correction in nearly a year. It's important when we go through these times of hyperactive volatility to remember why we invest in equities in the capital markets for the long term. If we review what's gone on in most of the major indexes here in the month of October in 2018, pretty much every major stock index reached correction territory. We've seen a little bit of a bounce here in the last couple of days from the lows experienced throughout the month, but like history suggests, October tends to be one of the worst performing months of the market. What I would like to do today is to provide some clarity as to what's going on so that all of you can continue to make good long-term decisions with your finances and your investments. So if we review the history of stock market corrections, it's important to note that what we just went through is a very normal seasonal correction. If we review what happened from peak to trough, the market dropped about 10% at its worst from its highs experienced at the beginning of October. It's important to note that even though it's uncomfortable, 10% corrections on average should happen about one time a year, and 5% movements should happen on average about 3 times a year. I understand when we go through these periods, it's very uncomfortable, and it's easy to rethink your portfolio and to question if you're doing the right thing. Let's talk about why it's important not to overreact when we go through these periods of volatility. So let's talk about why it's important not to lose our cool. Let me give you some perspective. If we look at the S&P 500 dating back to the early 1980s, what you're looking at here with these black bars is where the market finished in terms of its bottom line return for the year, and the red dots represent the total amount of volatility experienced throughout that calendar year. What you notice here is that every single year there's a red dot. Some years have more volatility, some have less. What I want to just show you why this year feels so uncomfortable. In 2017, the market experienced only about 3% total volatility, as opposed to this year where we've seen a major change from about 10% volatility. But what's important to note here is that through every year, on average, we should see about 14% total drawdown in the market. Now, that doesn't necessarily mean that the markets are going to finish negative for the year. Remember, volatility is the price we pay in order to achieve long-term returns and to help us grow our capital in the long run. Now, you might be asking, what's causing all of this turmoil after such a positive year? Well, it's very simple, and depending where you get your information, it's not always easy to get this. But what's driving all of this is simply a rise in interest rates. After nearly 30 years of pretty much flat interest rate movement, the Federal Reserve has finally started to raise interest rates more towards regular levels. When interest rates rise, it begins to signal that the economy may be overheating and that it's time for us to cool things down. The other thing that it does is it starts to change the dynamic relationship between stocks and bonds from a risk-reward standpoint. As you can see here, when we look at the yield on the 10-year Treasury curve, interest rates are starting to eclipse 3% for the first time in nearly a decade. What that means is that the yield on the Treasury curve is now almost equal to or greater to the S&P 500's average dividend yield. As the risk trade-off increases between stocks and bonds, investors are more likely to move their money from stocks and into bonds, which creates a little bit of tension. But I think it's important to note, if you study the stock market over the last 50 years, historically, the 10-year Treasury shouldn't affect equity valuations until it eclipses 4%. Now, given the policy that the current Federal Reserve has put into place, I don't see us reaching that number for at least another 12 to 18 months. So what's happened here in October is this sudden rise in interest rates has really started to impact investor behavior. This is why I want to make sure we understand why we keep our cool through these types of moves. If we look at what's going on in the global economy, even though it feels like it's a little bit of a scary time, ultimately all of the major economies are still going through the late cycle of the expansionary phase. Our friends at Fidelity have showed us here that none of the economies look like they're getting anywhere near the contraction phase in the economic cycle. Granted, it is fair to say that economic growth is decelerating, but it's still going up. It's just increasing at a slower pace, which is very normal for this part of the economic cycle. So there's still a lot of things to be very positive about, not only here in the United States, but across the world as well. We have record low unemployment. We still have historically low inflation that doesn't appear to be getting out of hand anytime soon. And we also have companies continuing to increase earnings at record pace. And with very liberal taxation laws here in the United States, we should continue to see that earnings growth going forward into 2019. We talked about why it's important to maintain our composure, but let's remember why we invest for the long run. It's easy to think that we're all smart day traders and that we can outthink the market on a given day, but history shows otherwise. I found this to be a great visual to share with all of you because timing the market is proven time and time after again to be a fool's game. Corrections breed opportunity, and they give us an opportunity to buy good companies with great earnings at lower price multiples. But the hard part is we're never going to know when those lows are and when the highs are. So trying to figure them out on a day-to-day basis will never end well for anybody. So when we look at this chart, if we stay fully invested, and if we would have stayed fully invested for the last 20 years, we would have seen on average a 7% total return on our money. But what you begin to see here is if we try to time the market and try to outthink things, if we start missing the best 10, 20, 30, 40 days, our bottom line return starts to look pretty ugly. So what's the point I'm trying to make here? Don't worry about the headlines. What I want you to worry about are your long-term and short-term financial goals. Investment success is directly derived by how you react to these major movements in markets. If I show you returns over the last 20 years, if we zoom in here and look at how the average Joe investor performed, they've only returned about 3% on their money. And it's not because they picked the wrong mutual fund or the wrong stock. It's because they made a bad decision when the market was either heading in the direction down or up. Whereas if we stay diversified and we focus on a high quality portfolio that's diversified across different asset classes, we're averaging nearly 6% over that same 20-year period. So what I want all of you to do is take a deep breath. I know this is uncomfortable, but remember what financial planning is all about. We want to focus on what our wants and our needs are. For those of you who have short-term goals coming up, now is probably the time for us to look at putting part of your portfolio in more conservative pockets so that we can protect those assets against these types of volatility. But for the long-term money in our portfolio, we need to be looking at these corrections as opportunities so that we can continue to grow your net worth over the long run. So again, it's all about the hierarchy of knowing what your needs and wants are. If you feel that your comfort with risk has changed or that you have major goal changes coming up in the near term, let's have a discussion to make sure that your portfolio is built appropriately for those financial needs. Lastly, I thought it was important to just touch upon the fact that we are in an election year, and that does get lost in some of these headlines on a day-to-day basis. While most of this recent volatility appears to be caused by rising rate fears and also trade war fears and that it may accelerate inflation, we also have a pretty big election cycle coming up with the midterms about a week away. I was able to find this chart, and I thought that this was a great visual to show all of you why political matters don't really have an impact on our portfolios. If we look at how the S&P 500 has performed going back to 1994 during various investment cycles through midterm elections, it's interesting to note that the market tends to see a lot of volatility in the first 3/4 of the year, with a major rally breaking out in the last 2 months after the midterm elections have subsided. So, if anything, this is a pretty historical and seasonal correction that we just went through. This is nothing that we haven't experienced before, and I think we need to look at this as a real opportunity in order to continue to grow our net worths as clients. If any of you have any further questions, our team is always here to help you. We really value the fact that you trust us, and we want to help you make good long-term decisions so that you can have confidence in the path that you're on regarding your financial life. Thank you as always. Again, my name is Mike Shillin. We look forward to seeing you soon. Thank you.